How are you, folks? Enzo DiCostanzo, clinical professor, economics and finance at St. Peter's in Jersey City. And today we're going to be hitting the part 2 of the lecture for assignment number 3. We're going to continue interest rates and markets discussion, and we're going to graph the S&P 500 and talk a little bit about the S&P 500. So let's get right to it. Okay, folks, we stopped here yesterday at this little part which says effects of expectations. And really, I was just watching one of the Trump attorneys on, and again, I'm not, you guys know me from what I say in class, I'm not taking sides on anything. I'm just saying that the latest case that was, I think, erroneously presented as a criminal case, and it's not even a criminal case, it's a civil case looking for monetary damages. I just watched the attorney for Trump discuss that. And the reason I'm mentioning it is the whole valuation concept and the whole idea of expectations as it applies to what we're talking about in our courses. First thing about the New York State Attorney General. If you're number one, I think what happened behind the scenes, knowing a little bit about the legal system in New York State, I think the regulators, because believe me, judges, prosecutors, they all have someone regulating them. It's not just, we have a lot of checks and balances in this country. I think someone went up to her because the guy pursuing Trump for the alleged criminal fraud or whatever the latest allegation is, was let go or fired or voluntarily resigned from the New York State Attorney General's office because there's just simply no case to pursue. Okay, that's the first thing. And then I guess out of frustration, she said, okay, we'll file a civil case, which is a far lower burden of proof. And also, she was probably told by the legal profession regulators in New York State to stop wasting taxpayer money chasing your tail, which is unfortunate. And it's an ugly thing to see, but we're seeing at a very national level. And I've been very aware of many situations like that at local levels. And it's just whatever, some small town somewhere, whatever it might be. But now it's risen to national prominence and global prominence, and that's a big point of me always harping on you guys about being honest and having integrity and having morals. And either, again, especially if you work if you work for the courts or work for attorneys or something, you can't play too, of course there's a little sophistication that's involved in everything, but you can't play these horrific games with the legal system and with people's time and resources and their reputations and things of that nature. There's a prosecutor in Baltimore who I think has been hammered numerous times by the police union for, I'm not saying making up stories, but pursuing cases that otherwise just in maybe a little more of a balanced environment that we're not in right now wouldn't be pursued against the Baltimore City police departments. She's had to defend herself a number of times, and then there were some things that she did that people said, hey, you're pulling a string on us. Look at what she drew money from her pension or something and things of that nature. Anyway, but getting back to the Trump thing, yeah, I mean, look, properties, the latest fiasco that's unwinding right now is the Trump inflated the value of his properties, and his attorney said it. She says a property is worth what someone is willing to pay for, and there's no math, there's no accounting that's going to validate that. It's if you've got the bank account, if you've got the bag of money to execute a transaction, you're willing to do it, and you're doing it, you're not being pushed into it or adversely influenced to do it or threatened to do it or anything like that. You can overpay for an asset. You can overpay for 40 Wall Street. You can overpay for a real estate property. You can overpay for whatever. So, and the reason that we're talking about that is, certainly we're talking about valuation in our classes a lot, and also expectation. So let's get to the idea of an expectation, and certainly politically and from a business perspective, certainly from a market perspective, if there's an expectation that the Federal Reserve Bank is going to increase interest rates by, let's say, 0.75%, and then it really increases them by 1%, it's one of the eight, if it's one of its meetings during one of its 8 meetings during the year, if it raises it more than the expectation was, that's going to cause panic selling in the markets, and it could be the stock market, it could be the bond market. And yesterday we were having a little bit of a spirited discussion about bonds and stocks and how interest rates impact the decisions that you make. Are you in the debt market? Are you in the equity market? Are you in the bank CD market? Are you in the treasury market? And the yields that you're looking for, and how that impacts the sentiment out there and the thinking out there. And we're all very educated people. We sit there and hopefully you make decisions based on a lot of information. But a lot of people in very fancy jobs make decisions based on emotion, and it's not, everything isn't as logical as the math department of Rutgers Newark would like it to be, or as I would like it to, or maybe as you would like it to be. So that's just something to keep in mind. So expectations are extraordinarily important. I didn't want to rush it yesterday. Yesterday's lecture went on for like 2 hours or so, or something to that effect. I just wanted to be careful with that we didn't make that too long of a lecture. So anyway, so rising or falling interest rates can affect the consumer and business psychology. That's a big piece of the puzzle. That's a very big piece of the puzzle. That's not minor. When interest rates are increasing, businesses and consumers will cut back on spending. Well, yeah, because on the unfortunate idea, the unfortunate fact is, when you have an income statement and you've got to take more of your gross income, more of your gross profits to pay for debt, that's going to be less earnings. When you have less earnings, you have less of a valuation. When you have less of a valuation, the dollar value of the shares of the stock decline, okay, or lower than maybe you expect them to be. So this will cause earnings to fall, stock price, we just said that, stock prices to drop. On the other hand, when interest rates have fallen significantly, the consumers will increase spending, causing stock prices to rise. Okay, so those are things to keep in mind. And actually, these probably should be separate. The reason I wanted the Word document is that as I go through my notes here, I always wanted to actually, this should be both of these like that. Okay, so you have the comparison. So when interest rates are rising, what happens to businesses and consumers and their spending, and then what happens when interest rates increase, when interest rates decline, what generally happens? Nothing has to actually happen to consumers or companies for the stock market to react. In other words, it's not like there's a lawsuit or some product isn't going to sell anymore, or they have outdated technology or whatever, some catastrophic thing, or maybe not so catastrophic thing, but just some sort of negative impact on the company. It has, in other words, what that line, this next line says is, there's nothing that fundamentally has to happen to a company. Just the idea of increased interest rates just sends a chill through the market, and people start selling, and it's not a good it's not a good environment, or it's not a good event to happen to cause confidence in buying shares in companies. And like you said, and there's impact on the stock market, impact on the bond market, impact on real estate, impact on treasuries. There's impact across the board, impact on all the consumer credit products, the business credit products, all those kinds of things are impacted by this. And especially the environment that we're in now. We created the graph yesterday, right? Yeah, we made this graph yesterday. So again, this goes back to, I think, the last 3 recessions. So we had 1 recession, 2 recessions, 3, actually the last 4 recessions are here. I should probably put a little box here that says that. And actually what we can do, we can go to insert, shapes, text box. This is last 4 recessions. See this little, so if you want to put a little note, you can do that on your graph. And what we can do, we can outline this thing in gray. We can outline it in that. We can fill it with do a white fill with that. And yeah, and you can grab, you can click there, Control A, center, and all, and then bold it, something like that, and shrink it a bit. And so now you have a little box here. And let's fill this with a nice white. There we go. That's what we meant, something like that. Okay, that's the last 4. Even better to do something like that. Okay. So you guys, if you want to put a little text box and help you explain your graphs a little bit, you can work on that. So again, fundamentally, nothing has to happen to the companies or the consumers for the stock market to react to a perceived interest rate change, even before the Federal Reserve announces a hike. So if there's a lot of uncertainty, if people say, oh, well, 0.25%, decline or increase, then 0.5%, then somebody says, well, 1.5 or something like that. So all of that all that uncertainty. Markets don't like uncertainty. And again, you folks are too young for this, but the Volcker years, the Greenspan years, there was nowhere near this amount of guidance. It started with the Yellen, when Yellen was head of the Federal Reserve. That they were really, Bernanke, those folks. Bernanke actually really was the guy who ran the U.S. Central Bank during the as Greenspan was jumping ship, seeing what was going to happen, kind of a thing in the mid 2000s, where the Federal Reserve was really being far more transparent than far more transparent than it was previously. That's for sure. It says this can cause earnings to fall, stock price. Well, okay, so it says even before the Federal Reserve, and that's how business and consumers may potentially cut back. Okay, so if there's a cutting, if consumers and business spending is being cut back or reduced, certainly earnings can fall in the companies. When the earnings fall, stock prices drop. Okay. And it says the market may tumble. And so you're getting so many, like I said, I didn't want to rush this yesterday because there were a lot of pages of notes here. This is such valuable stuff. I hope, like I said, folks, this is, even though you don't have the outline version, but here, you have it all right here. I hope you're reading this. If there's an important 5 pages that you're going to read this semester, it's this stuff. This is really important. And the recession, I put some extra material in here, some recession material and things of that nature. So please spend some time. Okay, spend some time on this. Yes. On the other hand, if people expect the Federal Reserve will instead announce a rate cut, the assumption is consumers and businesses will increase spending and investment, and this can cause stock prices to rise. So again, we care about the behavior of a consumer, we care about the behavior of business, we care about the behavior of spending. How people spend, how businesses undo. How people spend, kind of a thing. All right, and it says this can cause stock price to rise, and like I said, you can look through that. Okay. But if expectations differ significantly from the Federal Reserve's actual actions, so this week we had meetings with the Federal Reserve, and I discussed this yesterday, and certainly we could discuss it again. We could just type in FMOC. What do we have here? We have this thing. Yep. And then you have the dates, the transcripts, the meeting calendar. So this year there was a January meeting, a March meeting, a May meeting, a June, July. May, June, and July, there's 3 months in a row. And then September, and they skip. August there's a meeting up in Wyoming. And then November, December, we end the year. So obviously, and you can see relatively quickly, we don't have the minutes of the meeting. These were released a couple weeks later. So within a month, it looks like this stuff is released. But certainly within 4 weeks, less than 4 weeks, the minutes goes through the details of what was said at the meetings. You have 2021's meetings. Okay, but obviously we have what the statement is, and I think we went over that in yesterday's video. So we started with that. Okay. It says the Federal is expected to cut rates by 50 points next week, but announces a drop only 25. The news may cause stocks to decline because the assumption of a cut of 50 has already been priced in to the market. Well, I mean, that's, you could sit and argue and say, well, we expected 25, we got 50. And then, how did that? So obviously, looking at that, it says, well, and now looking at this, it says if the market's going to decline further, and that was already priced in, but you only got a drop of 25 basis points, I would think the market would go up a little bit. But and it says the news may actually cause stock. Well, maybe, yeah. I don't know if I'd agree with that statement, but okay, the guy who made these notes is saying that, but I don't know if I'd agree with that. All right, now we have a couple questions here. So yeah, we have the bottom line, and that's it. And we're not going. Mohammed Al-Areen is an Egyptian economist, an Egyptian analyst. He ran the California pension system for many years. If there's one guy you're going to Google to understand the economy, him. It will be him. So there's a couple questions. It says, what happens to markets when interest rates increase? When an interest rate increases, the cost of borrowing becomes more expensive. Purchasing goods and services more expensive for consumers and business through debt. So, for example, purchasing a home becomes more expensive because the mortgage rates rise, and the financing growth for business also becomes more expensive as rates on loans increase. Okay, so financing, mortgage rates rise, financing growth becomes, well, it says financing growth, financing economic expansion. Like I think I used the example, the landscaping business that in Essex County, they have 25 trucks and 50 lawnmowers and 100 guys and a bunch of rakes and bags, and they have all the equipment they need. And they're doing far better than if they had one truck, if they had and a lawnmower, and maybe not even that. So it says when this happens. Now, the other part of this is when consumers spend less, the result is a slowdown in the economy. So again, so you have both. Actually, this just takes one angle. This takes the interest rate increase, which slow down the economic activity. When interest rates fall, the opposite effect tends to happen. So so it didn't go through the details, but the opposite effect is an appreciation or an expansion of the economy, right? When interest rates decline, and everything that comes with that. How do interest rates affect inflation? Rising interest rates curb inflation, while declining interest rates tend to speed inflation. That's something I wanted to keep in mind. So again, as we increase interest rates, we're trying to reduce, because you're slowing down economic activity by increasing interest rates. So hopefully that is going to reduce inflation, which is what we're attempting to do from a monetary policy perspective right now. The problem is the fiscal policy of the federal government, which spends a couple $1 trillion more in relative to its tax revenue than it brings in. Right, so that's you're continuing the economic activity that the monetary policy is supposed to slow down, and just by legislation you're increasing spending, which federal spending, which is not helping anything right now. Even though there's an appearance of that, it's buying votes. Right, nothing against Detroit or Baltimore or any of these kinds of places, but that's what's going on. I'm just saying that's what's going on. So anyway, as rising interest rates curb inflation, the declining interest rates tend to speed inflation. When interest rates decline, consumers spend more as the cost of goods and services are cheaper because financing is cheaper. Okay, increased consumer spending means an increase in demand, and increase in demand, it means increase in prices, more economic activity, higher prices. Conversely, when interest rates rise. Okay, so looking at this, it says how do interest rates affect? So you have both versions of this. Okay, you have a decline, the decline version here, right, and then you have the expansion version here. Consumer spending and demand declines, money flows reverse, and inflation is somewhat tempered. Which is the second part of what we're trying to work on right now, from monetary at the U.S. central banks. Third part, how do interest rates affect stocks? A rising or an appreciating interest rate hurts the performance of stocks. If the interest rate rise, individuals see a higher return for their savings. This removes the need for individuals to take on added risk in the stock market, resulting in less demand for stocks. Yeah, so that's another perspective to look at it. And we went through in a lot of detail yesterday. You have to sort through in your mind. Are you talking about the interest rate of a current bond? Are you talking about the yield of a current bond, the yield of a new bond that's issued with a higher interest rate? Kind of a situation. Obviously there's going to be a demand as interest rates increase. Right, obviously there's going to be a demand for a higher coupon paying debt instrument from a treasury or from corporate fundraising through debt and things of that nature. So if there's instruments out there that have a higher coupon and are going to give you a higher yield, that's how to look at that. So as you're increasing interest rates, capital piles in to those into the new instruments. So what happens to the old instruments? There's less of a demand. If there's less of a demand, the price of the older debt instruments declines. That's what they're talking about when they say appreciating interest payments and declining price of currently held debt instruments. Okay, so you have to really distinguish. The Wall Street Journal has a very general sort of version of that, and then certainly the reverse happens. If there's a decline in interest rates, that kind of a situation, certainly the new instruments are going to have a lower yield, a lower coupon payment. There's going to be less demand for that. If there's less demand for that, the current ones are going to be more demand. So if the current debt instruments that have a little bit of a higher rate than the current market is going to allow for, those will be bid up a bit. So as interest rates or the central bank monetary policy decreases interest rates, current instruments, the price gets bid up, kind of a situation. And also as the price gets bid up, that yield shrinks because you're paying more for the same fixed cash flows. And we discussed that yesterday. So anyway, so interest rates affect the economy by influencing stocks, bonds, interest rates, consumer business spending, inflation, and recession. However, it is important to understand that there's a general 12-month lag in the economy. I've been saying this all my classes, and I told Mike and Pete, there's also that, okay, fine, we had an initial reaction in the stock market, but also in terms of the economy, in terms of what UPS is going to do, in terms of what Walmart is going to do, in terms of what the retailers are going to do, and all sort of the brick and mortar, what those folks are going to do. They can't, even Walmart, they can't move as quickly. Are they buying more trucks? Are they leasing more trucks? Are they employing more drivers to deliver more products to their stores and things of that nature? So obviously, if the economy, if the economy is in decline, it's going to take a couple, there might be agreements that were forged 6 months ago to deliver this and deliver that. But once those agreements are over, those agreements might not be renewed to deliver tires and oranges and potatoes and car batteries and bottles of motor oil and whatever, and clothing and blue jeans and sneakers and t-shirts and sweatshirts and whatever, to flowers and frozen potatoes, whatever it might be, right? Actually, there are frozen, tater tots, right? Whatever it is, milk. So you might not be making the same deals to stack up with the same amount of merchandise. Okay, so that's where it takes a little bit of time. When I say there's a 12-month lag, that's what's meant by that. So by adjusting the federal funds rate, the federal funds keep the economy in balance over the long term. Understanding the relationship between interest rates and the U.S. economy will allow the investors to understand the big picture and make better investing decisions. And folks, before we hit this last paragraph here, you really got to understand. If you want to really follow what's going on in the economy, you want to follow someone who has something to gain and lose. I hate the whole skin in the game idea and the concept, but that's really what it is. Walmart is they're a very vested interest in what happens with the economy, so they're going to say what's really going on and watch their hiring, watch their pricing, watch the behavior of that firm, and it's basically a firm that's bigger than outside of about 10 or 12 countries in the world. Walmart is bigger than most countries in this world. If you look just from a revenue, if you compare revenue to GDP or something along those lines, but they'll tell you what's, you follow what they're saying. They're going to understand retail, and they're going to understand the economic health of the world. The McDonald's, the Exxons, the Walmarts, that's really who to follow. So there's no guarantees how the market will again react to any interest rate. Again, no scientist likes to hear there's no guarantees. Although the relationship between interest rates and stock markets is fairly indirect, the two tend to move in opposite directions. As a general rule of thumb, when the Federal Reserve cuts interest rates, it causes the stock market to go up. And when the Federal Reserve raises interest rates, it causes the stock market to go down. Okay. Yeah, something like that. Okay, so we finished that. Okay, so we had our conversation about this. So that we put a fork in that basically. So you had your part two to this, and we're not going to go through the guide here, but you should read it. In my opinion, you should read this. This is the guide to economic recession. Spend a little bit of time. This what is a recession, and there's so many different sort of definitions for that. It's a macroeconomic term that refers to a significant decline in general economic activity in a designated region. It's been typically recognized as 2 consecutive quarters of economic decline, which we've already had, in conjunction with monthly indicators such as employment or unemployment rates and inflation. The National Bureau of Economic Research, which officially declares the recession, says the 2 consecutive quarters of decline in GDP are not how it's defined any longer. Okay. But so it defines a recession as a significant decline in economic activity spread across the economy, lasting more than a few months, and is visible in real GDP, real income, employment, industrial production, and wholesale retail sales. And I think what's real, and the good and the bad of it is, for whatever reason, these governmental agencies are certainly, to say that it's just indifferent politically is naive. They're trying to. There's a midterm election coming up in a few weeks. And if a recession's been perceived to be caused by the current administration, egg prices and gas prices and all those other kinds of things. And here, let's look. And I don't want to spend a crazy amount of time, but BLS CPI. Okay, so a year over year, we're up 8.3%, and month over month, we're up 0.1% or so. City averages a little bit higher than, and then city averages, and also this is less food, and this is all items. This less food. See, here's the problem: these are generally going to be less than the overall CPI, but this takes out very volatile food and energy prices, and it's still high. That's what the concern is. So here's data, latest numbers. I want to see the press release, because this is on Fox News. This is the thing that those guys talk about. The price of eggs, the price of butter. And so this is how, this is 30. This is 30. They go into this news release. It's 37 pages long. So There's I want to go to the specifics where they get. Ever see the graphics on bacon and whatever? And here's the percentages. So here's cereals, dairy, food, meat, poultry, fish, eggs. So yeah, these are the percentage changes. So this August compared to last August, 16, actually 10%. And bakery and cereals, I buy a lot of cereals, 16%. Food at home, I really do very little McDonald's and a little bit, but not hardly any. Fuel oil, 68% this August to last August. Okay, so you're seeing right? It says unadjusted percent changes. So you're seeing the very specific categories, fruits and vegetables. And I know they had bacon. Is pork in here? Or poultry, fish? I didn't see it, but I know they're always putting how much bacon costs, right? The guys on Fox News always. So you can see there's 37 pages of this stuff. So there's a lot of it. Yeah, here it breaks it down a little bit more. Cookies, fresh cakes, cupcakes, white bread. Oops, the key stuck a bit. All right, what are we doing here with the specific ones? Snacks, major appliances, laundry equipment, olives, pickles, sauces. It really breaks it down. But still, yeah, you hear my olives complaints in class, right? 20% from a year ago. It's about right. That's about right. It's about 20%. Butter, sugar, roasted coffee, salad dressing, fats and oils, fruits and vegetables, dairy, cheese, related products, ice cream. All right, here's pork. Yeah, there we go. Bacon. All right, they were talking about this on Fox News. Bacon. So the percent unchanged or the percentage change here. This is ground beef, bacon. Yeah, 9% from a year ago. Breakfast sausage 14% from a year ago. Ham, a lot of 10% in here. Okay, for hot dogs. Oreo. They put Oreo cookies in here. No, cookies, white bread. Yeah, what's white bread? Yeah, 16%. Wow. So, and what's flour? 23. I use a lot of flour, make a lot of pizzas. Okay, so this is where Fox News gets these numbers. So they troll through this. And they have unadjusted percentage changes, apparel, and they really break it down. This is city average, all urban consumers. That's table 2. You would have table 1. That whole thing that we just looked at, that was all just table 1. Table 1 is U.S. City expenditure category, August consumer price index. Okay, I wonder if they have a list of tables somewhere. The Department of Commerce, they do this by listed tables is what they do this by. And this is okay. This is the month over month change. So okay, all right, July, fine. It didn't change, but it's been changing. You have had 1, 2, 3, 4, 5. You had 5 months in the last year. We had nearly a 1% month over month change. So this I consider that 1%. 1, 1, 1, 1, 2, 3, 4, 5. They're practically a percent change on the month, not on the year. And keep in mind that we like a target of 2% or 3%, for the year, kind of a situation. Yeah, I thought there was a list of tables somewhere. Maybe at the end there might be a list of tables or something like that. So this is city average expenditure category, August, all urban consumers. Right, I'm just going to copy this just for a second. Okay. This is a detailed expenditure. See, so as you're looking at this, yeah, that's a detailed expenditure. Fine. The table 2 goes on for a number of pages. Continued. There's 3. These are aggregate index indices. Yeah, this is the generally reported indices that you see, like the tables that we've had in class. 293. This was 100 a couple decades ago. Now it's up. Prices are about triple. This is all items less food, all items less shelter. So these are some specific indices that are studied. This is good. Like I said, I could do a whole course, and I could do a whole course just in this material. Okay. And you can see we're barely halfway through. This is selected areas by region. This is now you're getting very statistical. These are a chained index. See, there's a nominal one, and a chained one means that there's a reference year where it's 1 or 100 or something like that. That's what chain basically means. That so that there's more of a it's not just the nominal numbers. There's more of a reference year. Um, this is the 1 month change. So we're looking at month over month. Yeah. Adjusted, not adjusted, seasonally adjusted effects on all items, percent change. So yeah, if you like statistics, a government job like this is for you because they really go berserk in here. And I'm very blunt. You got to be very talented to do all. This is not easy or simple or anything like that. This is complicated stuff. This is very complicated. So there's a 1 month analysis, and what does this analysis mean? The larger and the smallest chain. So again, it's very statistical. It's very statistical. I've never looked through the whole thing like this. That's why I'm just taking a little bit of time with you guys to do it. This is 12, yeah, 12, a 1 month analysis, 12-month analysis, similar. Yeah. Okay. No. Good. So there. So there you go. So that's your pressure. And obviously, there's a top line thing. So within the first three sentences, it says the CPI for all urban consumers rose a 1/10% in August, seasonally adjusted basis, being unchanged in July. The U.S. Bureau of Labor Statistics reported today over 12 months, all items index increased 8.3% before being seasonally adjusted, and then it breaks it down into food indices and the core one. And folks, there's phone numbers here. There's emails you could email these people if you want to discuss this stuff, and who knows, what can happen with that. Okay, so but you have all that stuff sitting there for you. Okay, so that's some good material there. Okay, let's not worry about this right now. All right, so um, the recession thing we'll talk about it at some other time. So what else? What's next on the agenda here? Sorry, folks. Okay, the questions. So the S&P 500 is next. So your second graph is going to be a graph for the S&P 500, which is this. So you're going to make this graphic and going back to the same amount of time. And what I'm going to want you to do, and I could even do it right now, is here. Let's try to make this a little bit bigger if we can here. So even painfully maybe shrinking it a bit just so we can get everything on one screen here. But looking at this, here we are. Yeah. So if you look at this, I said there were 4 recessions here for what we're looking at. So as you're looking here, very high federal funds rate, boom, recession. This was when? This was in the 90s. And I know it's hard to see, but there's a little dip right there. If we made this really big, and I'll do that. Because we've piled so much data on here, it's hard to sort of see but see, there's a little, and I can see it. I'll make it even bigger for you, right here. And it's small, but I remember the summer of 90 into 91. You had a little bit of a decline. That's a recession. Okay, so this activity. So the S&P. So now this is the index. This is not the GDP. And way back, that would the GDP was sort of measured, or the GDP was used to measure whether you had a recession or not. Also here, 87, that was a stock market crash in that the fall there. So little, and also the scaling on this. If you looked at this just based on like this, this being the scale was 1,000, not 6,000, you'd see the effects of that a little bit more, but you could see it goes down. So that was one little recession right there. Then you had your second recession here, the 01. This is a little bit more clear. You could see you had a gradual decline to the beginning of 03, so all of 02, these are the Enron scandals, and .com. So there was a bunch of things that happened September 11 in the early 2000s. You had a 3-pronged area for a pretty good decline there. And the S&P dipped below 1,000 in 03 sometime. Okay, so as you're looking at this, you had high federal funds, then it dropped off. Boom, a decline in the S&P 500. Same thing here. High federal funds rate, decline, boom, decline in the stock market. Again, here, this is the Great Recession, the mid 2000s. high federal funds rate, fell off a cliff, and really a big dip in the S&P 500 valuation, which was right there. And then you have the fourth one that we're looking at, certainly the pandemic here. You had a pretty steep federal funds rate, and then boom, fell off a cliff again right there at the beginning of 2020. And now it's higher than we've ever been. But is it valuation? Is it inflation? Is it the book value of the company? What's driving such a high S&P 500 index? And also, and if you're sitting here saying, well, Professor, what's an S&P 500 index? Let's talk about that next. So yes, and again, I'm not going to go through every single line of this. I'm going to do a little bit with you guys of this. This is I have 2 lectures here, and I'll tell you what we're not going to do. We're not going to go see what says what are the 10 biggest stocks in the S&P 500. Yeah, we're not going to go through this market capitalization because that's a whole subject matter. But we'll talk about it. We'll talk about it here. Let's before we do anything else, let's get a definition of this. It says if you had to use a single financial barometer, and I think you have this. And again, folks, you have to upload your files, right? I have it some your student regulation model. Yeah, you've got it. So you have the notes are in Excel as opposed to Word, but they're in there. Okay, so you have both of these. Okay, so what's that? It says if you had to use a single barometer to indicate the strength of the economy, what would it be? You have indices for price, you have indices for quantity, but for the now with the GDP, I think there's an index, like a GDP index, but we don't look at it that much because it's measured in US dollars, so we just measure in US dollars. But even though the Dow Jones is the best known one, but the most quote stock index in the world is selective, and it can be misleading. I think we went through the companies on McDonald's and whatever the other companies were on, the General Electric or something, JP Morgan, Walmart, Apple, Travelers Insurance, whatever they were. And we did an analysis of the prices and percent. You can do it with 30 companies when 500 is a little bit tough. But the Dow Jones is the best known one. But it's only 30 companies. It's the best 30 though, or the pretty much the ones that are the strongest, financially soundest companies. The Dow is less representative of the economy as a whole than are several other indices. And it says paramount among those is the S&P 500, which is the de facto numerical indicator of the U.S. economy. Well, it's an indicator of the valuation of the stock market. So as the S&P index, it's an index. It's not based on euros or dollars. As it goes higher, that means the stocks are more valuable. As it goes lower, the stocks are less valuable. With unemployment, a higher unemployment is bad, right? But the S&P 500 index, a higher S&P index is good. Okay, so it gets second billing even in the financial media and little recognition elsewhere, but it's important, is vital. It's an equity index made up of the 500 largest companies trade on either the Nasdaq or the Chicago Board of Exchange. The S&P 500 is calculated by adding each company's float adjusted market capitalization. Market capitalization is the stock price times all the shares. So it's basically, now I don't want to say it's the value of the company, but it's the value to the shareholders of the company. So if a company has a lot of debt, that's sort of theoretically not in there. So it's not necessarily, it's the market capitalization of the equity. It's not necessarily the value of the company. The valuation, you have to add the cash, subtract the debt, and whatever. There's an enterprise value is really what you're seeking. And actually, let's hammer that specific define enterprise value. Let's see how we look at that. Yeah, it's more comprehensive than just the equity market capitalization. And there's a formula here to do it. Yeah, there it is. So it's capitalization plus debt minus cash. There we go. That's what it was. I mentioned that. And actually, my guys, my CFA team, I want to give them this. There we go. Cash, total debt. Okay, that's a nice little formula. I'll email that to them when we're offline a bit. 1 second, folks. 1 second. Yeah, sorry about that. Yeah, I just wanted to send just as we were talking about. But yeah, so certainly you're going to add back the debt, subtract out the cash, take the market capitalization, and then you can get an enterprise value. And that's something I might hit that topic at some point. But yeah, it's an equity index, 500 largest companies. 80 comes float adjusted market. Fine. And number three, in order to be included in the S&P, the company must meet certain requirements, including have a specific capitalization, have a majority of its shares in public hands, and being a public company for at least a year. So there's a time measure, the shares being held by the public, kind of a situation. Investors who want to invest in the S&P index can purchase an index fund or exchange traded fund that seeks to match the performance. Folks, that's not a bad little thing to have, like what's the firm out now? Vanguard or something, or some firm, some exchange traded fund, or some firm that allows you to buy access to the performance of this index, putting $1,000 a month or something like that in there, and over time just watch how that sort of behaves. So the first etymology, which is a study of origin of words, of the term S&P stands for Standard & Poor's, which is a company. Henry Poor was a 19th century financial analyst. Okay, the other guy who compiled the annual book that's listed publicly held railroad companies, and I'm sure Warren Buffett looked at it. The publication merged with the Standard Statistics Company in the 40s, and 500 is the number of stocks that comprise the index. So very value line-esque. Those are the classic companies I really look to in terms of now it's Bloomberg and Fitch and some of the other ones, but Value Line that I worked for, S&P 5, the Standard & Poor's. So as a financial analyst and a statistician that got together, and there's a message in that. Okay, there's a message in that. So the index includes 500 largest, not necessarily the biggest companies, but whose stocks trade on the New York Stock Exchange, Nasdaq, or Chicago Board of Exchange. Like Popes and Oscar winners, the components are selected by a committee, and the College of Cardinals and the Academy of Motion Pictures and Sciences. The S&P committee operates within a specific criteria to qualify for the index. The company must have the following. I met the guy who does this for the S&P 500. I met him a number of years ago. It was, good. It was good to me. I told him it was good to me. Yeah, so I said that to him. Okay, it says the market capitalization has to be a certain size. The value of the capitalization trades annually, at least $250,000 of its shares in each the previous 6 months. Most of the shares are in public hands, had initial public offering at least a year earlier, has positive sum of the previous 4 quarters of earnings, as well as the most recent quarter. So it can't be a company where it's just constantly losing money, and then it'll get delisted. So market capitalization is a certain size. A quarter, I don't know, is it a 0.25%, or maybe, I guess it has to have a certain number of shares. It says 250,000 250,000 shares traded in, or it has to have 250 million shares in each of the previous 6 months, kind of a thing. And actually, I just want to quickly look at that. So copy. Yeah, no, that's right. That's the right thing. Yeah, that's where I got it from. Okay. Escape. It has positive sum of the previous 4 quarters of earnings, as well as the most recent quarter. And the minimum market capitalization is 13.1 billion as of November 2021, which is about a year ago. Between the New York Stock Exchange, Nasdaq, and the Chicago Board of Exchange lists several thousand companies, but the first criteria alone reduces the number to less than 1,000. All right, so yeah, so the market capitalization right away pares it down from, like they said, there's about 1,000 companies. Then it's easy to see how the S&P can get down to 500 for inclusion, how the thing is computed. So, folks, when the Dow Jones was first sort of invented, it was 10 stock prices divided by 10. That's about how the Dow Jones was computed. Just doing that, and that's it. So, and I went through the computation about a year ago in my statistics class. But we're not going to recreate it. We're just going to talk about it. I'm not going to recreate it here, but the Dow was added up the prices and multiplied by a constant, that kind of thing. The S&P is a little more complicated. Instead of adding constituent stock prices, it's the company's float adjusted market capitalizations, counting only the shares available to the public, excluding those held by management, government, other companies. There are hundreds of publicly traded companies that keep most of their shares in-house. So many components, such as the stringent criteria for the S is dynamic. The index, the subsidiary of S&P Global that determines the components of the index, has little patience for non-performing companies. So I guess United States Steel has been around for a long time, and it was included in the S&P 500 for a long time, but it hasn't turned a profit in years. And when it fell below 4 billion threshold in market capitalization in 2013, the index was removed from the index, and Martin Marietta Materials, a construction aggregator, replaced it. A similar company and similar industry. So yeah, so that's that's pretty much. So I don't know if that's iron and stone or whatever. So the person who wrote this was a little creative. I'm trying to take out the colorful creativity of what this guy is. The guy who wrote this was talking about. But there's the S&P Mid Cap 400, and there's all sorts of there's all sorts of versions of this. There was a rebalancing was in December 2021, kind of a thing. Funny enough, FactSet Research, Solar Technologies were taken out of the S&P 500, and they were replaced by Leggett and Platt, Hanesbrand, and the Western Union, I guess, is back in there. And I guess some of them were moved to the Mid Cap 400, and they came out. So, they're sort of moved around the pantheon of respected spots in these indices, and it goes through the requirements. Technologically adept companies meet the S&P 500's list of requirements. Advanced Micro Devices was the largest microprocessor in the world, but fell off the index in 2013. It was added back again due to market cap issues. Turnover in this has been lower than you might think, though, but the length of time the components stay on the list is shrinking. A company buys a company that replaces on the index or spins off a large chunk of itself. The S&P 500 companies, Forest Labs, Beam, and Life Technologies, will purchased by larger companies. So other companies that leave the list when they no longer reach the market capitalization requirement. Typically, when that happens, the company is relegated to the index from which the replacement was promoted. In 2014, Rowan took Mallinckrodt's place in so it gets demoted to the S&P 400 mid cap or something along those lines. And again, it goes through different studies and performance and why the company was added, how it was replaced, why it was replaced. Now there's a bunch of questions here. Who keeps track of the S&P 500 indices, constituents? How does a company get added to the S&P 500? Does the S&P include Nasdaq stocks? And actually down here it says, what are the 10 biggest stocks for the S&P 500? I took the capitalizations from Yahoo Finance. I took the share price, whatever date this is, and I backed out the shares outstanding. So as you're looking at this is in the billions. So this is 16 billion, 7 billion, 2 billion, 661 million. You have to be able to read these numbers, jamming in a bill. I mean, you can do it, but the paper stuff it's still, even though we have a computer and we have expansive real estate to write everything in here, this is still written as if we were, it's still written as if we're doing this all on paper. But there's a capitalization. As you can see, Apple, Microsoft, they have these are big folks. This is 2 trillion, 2.8 trillion, 2.3 trillion. Amazon is $1 trillion. Tesla's $1 trillion. Alphabet, which is Google, they're almost 2 trillion. There's different varieties of shares. If you add up Google, both of Alphabet's, these are separate, not the same. You add those up. Google's the biggest one. It's 4. It's almost 4. So this Berkshire's in here. Berkshire's holding their own. Right, 777 billion. Right, if this is trillions, this is 777 billion. right? JP Morgan, again, and notice that the sort of the oldest stock company that's in there, JP Morgan's at the bottom. It's Apple. Those are by far. And look at Apple, look at Microsoft compared to JP Morgan. They're, how many times is this? 5 times, right? Microsoft is 5 times bigger than JP Morgan. So those are all things to keep in mind. Can you just invest in the S&P 500? And there's some we looked at again, whatever, March or April or whatever it was, we looked at these indices and determined. So obviously we were in an appreciating time right here, right? In whatever it was, the summer we just had, right? You're up 5%, 7%, 4%, but now we're down 20% for the year. 2022, we're down 20% for the year. So it can change. Okay, this stuff can change. Okay, for the most part, the S&P doesn't convey information that differs drastically from comparable indices. It broadly matches more exclusive Dow Jones and more inclusive Russell 2000 indices. Even so, the S&P represents a happy medium of sorts, comprehensive enough to indicate the relative strength or weakness of the larger economy, but not so exhaustive to include too much noise in the signal. Overall, it's an index of indices, bellwethers adopted by analysts, policymakers, ordinary market participants alike. Okay, so it's a number. As it goes up, more valuable. As it goes down, not as valuable. There's another set of notes here. I didn't even what do you call it? I didn't even outline these, but there's an example here. What is this? It says, in order to understand how the underlying stocks affect the S&P 500, market weights must be calculated divided the market cap of each company by the total. Below is an example. See if common shares issued and use the company's annual filings. You had a specific stock price. You computed them. A market capitalization, the share price times the number of shares that are out there. So yeah, have the total market cap of the S&P 500. You divide Apple's by the market cap, and you'll get something like Apple is 7%. The weighting is 7% of the index. Because if the whole market cap is 40 trillion and Apple is 3, that's almost 4 over 40. That's almost 10%. Okay, like I said, I didn't go through all of this, the second version of this, how it's constructed, but we'll do that in another. We'll do that in another lecture. But company market capitalization divided by the total of all market capitalization. Okay, that's how that works. So yeah, so you had those. Okay, so now the last thing that we're going to do for today, we're going to do the graph. So we're going to make this graph. Okay, so if you look at your student sheet, which is here, I gave you the data. The data is right here. Okay, I took this from Yahoo Finance. I just downloaded it. That's it. So all you do is you go to Yahoo Finance. Okay. You could even do historical S&P 500. Now, I don't know. Did I give you the link on your assignment how to do this? Because yeah, the what do you call it? The St. Louis Fed doesn't have it a deep amount of it. So yeah, you had the St. Louis Fed link here, but I gave you the data. So yeah, here's the historical price. So I don't. Well, how far can I go back with this? Did it go back to 1927? I don't think so. I'll feel silly if I didn't think it went back. Yeah, it just went back to 85, and that's it. That's what I thought. It just went back to January 1st, 1985. That's so. Well, if you do daily, I think it would be too much. Because we asked for this. We said let's go back to December 27. But daily, if you do a daily, it'll be so it'd be so unwieldy. So anyhow, so all I really did here, I'll just do it like this. I just selected this stuff, and folks, yeah, again, I apologize for that, folks. I went down to the end. I went like this, right? Look at the index a couple years ago. A couple years ago it was 100, or a couple decades ago it was like 100. Now it's like 4,000 or 5,000. See that? Look how we did that. See, I just highlighted it, copy, and then just dropped it into there. That's all I did. I dropped it into a Word, a notepad. That's it. And then from here you copy, then you fix it. And Excel, you move it around, you move things around a little bit. You have to have a little, folks. You have to have a little bit of dexterity with this. All right. So here, where is it? Down here. Actually, this was federal funds. Yeah, for whatever reason, I don't know why the arrow key is not cooperating with me. I don't know why it's doing that. Yeah. So. Okay, so what you're gonna do now that you had the federal funds numbers here. So what you'll do is you could come over here. This is yesterday's sheet that we were working on. Give yourself, you're trying to make some space for the graphic, because I want the graph sort of right under one another. Okay, so you want to put the thing in right about there, right? That's your first line. Okay. All right. So what do we have here? So again, I gave this to you guys under here. I'm taking yours. Now, I had to sort of flip it a little bit and I sorted through it. So instead of going bananas worrying about that, I'm just going to take this like this. It's 400 something pieces of data. And we're just going to go right, do right. Okay. Like that. And that's it. And we're going to graph the closing price. That's why I put the gray bars over this. So yeah, we have this lined up just right with our, we want this lined up with our federal. It doesn't have to be, but I like to look at it like that. So, and actually this, just put a nice light version of this, right? Just for the mind's eye. So that's it. So you can just take the data, in Excel from there. Like I said, so I sort of did that part of it for you. But to see sort of how we would do all that, what I can do on the side here, and I'll show you what I did. So we have all the data here, and see, the currency, and this is just a little copy from the notepad, and you're gonna just drop it in. Oh, look at that! I did it just right. So yeah, my first data point. Yeah. Okay. Open this up a little bit. Right, and then what I did was I went back to the Yahoo page and I just copy and pasted this, right, like that. Okay. I just pulled it out of there. I can take this, copy, and go to this, and just sort of drop it in here someplace. We cut this, put it there, made it in italics, made it a bit smaller, right? Went to 10 with that. This, we cut this one down here. We bolded this, right? Increased it a bit. That's it. Now this other stuff, the date here, you can see this is the recent one, and this is 1985. So obviously we need to do a little work here. But here, Shift Control down arrow up. You just want the dates. So what you'll do is you'll say Control 1. You'll have a date. You'll have this as a choice. You can do font, make it a little bit smaller. I didn't do italics with it, and you can even make it blue. And hit OK, and then you can center it. Right? And what is this? This was caliber 11. This was, is this bold? This looks bold for some reason, but it's not bold. No, it's not. Caliber. Oh, okay. Well, I guess we increased it. It was actually, yeah, it doesn't look, something looks off in this. I don't know why. I'm going to increase this. Increase. There we go. Now it looks like it's supposed to look. Okay. Now you have to format all the other parts. Here's the headings. We'll highlight all the headings, bold, center, and you know what you could do? You can make them text, right? You can make them a text if you want a little bit too, like that. The volume, you want to open this up a little bit. Okay. These number, I mean, I didn't format every number here because all we really care about is this. I care about this one, which is the closing price or whatever, the closing amount right there. And actually, this stuff, I had a touching Control D, Alt HHN, copy right there. And under close, Shift Control down, Control 1, number 2 decimal places right there, center, and hit OK. And I think we should put the separator in there, the comma separator. Okay, that's all you could format everything else too, but and then what we did, and it'll be Shift Control down, up by 1. You're going to go to sort oldest to newest, and it'll pick this. It'll pick the first. Hopefully, pick the first version of that. Yeah, didn't do it just right. Right there. Sort, and what it'll do, it'll use the dates and should use the dates. I don't know why it's skipping one on us. I don't know why it's doing that. Oh yeah. This is the 23rd or something. Yeah, I just noticed something. Okay. Yeah, there's one too many on this. That's fine. We don't need the end of. What it's doing is but this first date, take this, we can cut it. Okay. Now, and what it'll use the dates to do oldest to newest. There it is. Okay, so there we go. See 179, 181. What it's matching these. And also what you can do, you can cut this and put it right there. Okay. That's how I worked getting yours, that's how I worked getting yours together that way. So you can see now. See, they match, right? They match exactly. So that's how I got there. Okay, so what you're gonna have to do is you're gonna have to graph the 179 based on time, and if you go through this one, we're almost up to 4,000. So this one's a very big number. So how do you do that? So this is you have this is the closing index value. The adjusted one adjusts for splits and dividends, and don't worry about that. So you're gonna get on the first one, shift control down arrow. You'll go to insert, you'll go to scatter, and you can just go to whatever this scatter with straight lines. And there's your S&P 500 graph. Now, there's a couple of the things you have to do here. You want to go to select data, edit, X. You want the same from whatever, from January 1985 to today. You want to have that. And this is just going to be, I forget what we called it, but this is just index. Okay. Then hit OK. And we're going to worry about the scaling. We're going to worry about that in a second. Yeah, okay. Currency US dollar. Okay. Yeah, and we could do it like that. Okay, fine. So here, go to layout, legend, top, design, select data, edit. This is currency USD. There. And actually, let's get this thing out of here. Well, you know, we want to work on it where we're going to be dealing with it, which is right here. So what you want to do, you want this to have the same size and all that, and the same. So because you want to compare and make it a little bit bigger like that. Now we got to fix this. This goes back to whatever, to 1900 or whatever it might be. Yeah, the 50s, the 60s. So you could right click. There's a couple things you could do actually. Go to design. Remember the chart layout? Instead of going element by element, you could just go to layout, go to design, and it'll give you the titles. And then you have to put it bounces the legend back. So you got to put it back to currency. And this was S&P 500 index. Double click in here. S&P 500 index. And then, excuse me, S&P real time. Price. And you can make this part of it a little bit smaller. Like that. And around the border, you could just do a dark border. And you can even fill this if you want, but let's not worry about that right now. This was the month. Just click there. Month. And again, put a border, that dark border. And this is, put a dark border there. Index. How's that? So it's getting there. But now obviously we have to cut this off. So here, let's right click on the dates, format the axis. And there we go. So it was searching, I guess, for this or something. I don't know why. Format the X. There we go. Okay. What is that? That's 50,000. So the minimum is 0. So you want to cut off about, let's make this 40,000. And let's make the major unit 300, something like that. And let's angle those. See what it says alignment? Let's angle those dates. And you can shrink them a bit. They don't need to be so big. Now we're going back further, so let's write. It's not this is 2009, so we want better than that. So let's do 20,000. And you got to practice. That's no good. Let's do 30,000. Better. Okay. And if you want to lighten up, if that's too cluttered with the dates, so instead of 300, you could do maybe 325, something like that. Okay. There you go. There's your index. And what we're going to fix, we're going to still do some things with this. Now, the tough thing with this is that you have a big range of the y-axis is pretty big. And you could do, again, your dark border, do your fill, do your shadow or something right there. Okay. Right click, grid lines, thinner, dashes. And again, I'm partial to some of these colors. We could even do like a blue or something like that. How about that? There's your graph. Okay. And what you do is you're going to look up here. You're going to look up here and you're going to say, okay, recession, early 90s, again, that little blip, early 90s recession. This is the 01 recession, the dot-com. This is Great Recession, COVID. Okay, now what, Ukrainian war. We're now, what we're doing here is, we're up again, and we're suspecting that what's, eventually this is going to go down, but we're increasing here, so we're in our sort of fourth or fifth one in the last 30 years or whatever this represents, last 40 years or something like that. Okay, so like I said, you can overlay these. I like having them like this because you can have the scaling of the graphs, relatively consistent for what your graphing is. So now, in terms of this assignment, and we've done it, we've said it before, and I'll say it again. Let's do this. You're here. Yeah, so I did it for one of the assignments, the previous ones. See, for the cover page or whatever it is. Yeah, see, this we can do it again. I'll do one more for you. This is whatever, assignment number 3, right? Assignment number 3, and again, the appropriate date and class. This is just in Word. This is just in Word. Now, these are the questions, whatever the questions for the assignment I worked on. But you're dealing with you could do either thing here. We could go to. I know you have the PDF. You could do this in the PDF too. You go to questions, right, like this. You copy them. You can do this in PDF also. It'll work the same. And then you're going to go to your whatever. This is I think the first assignment, right? You're going to click here and just paste. And it just drops and you just type in, give yourself some space. PDF is the last step. See how you're giving yourself space? Right? That's how you deal with this. There's others. This is for graphing, and actually, this we don't need. And actually, there's something else. Yeah, there's nothing else here. Yeah, this thing we don't need. We don't need this right now. And also, when you're reusing, you want to say you don't want to accidentally save over your old sort of file. So this is going to be assignment number 3. What are we doing here? This is interest rates markets SP500. And yeah, maybe we can laugh. What was the due date on this thing? What was the due date? I think the due date was the 26th. We could laugh at that, I guess, at my due dates. Okay, something like that. October 3rd, whatever, October 3rd. Okay, so you could go back and I'm just renaming it right here. But folks, all the stuff that you work on, it's all got to make sense. It can't just be file or something like that or whatever. It's all got to be things that make sense. Okay. And then obviously you put your first name, your last name, all that. And then, like I said, in terms of the graphics, I mean, you could drag in the you could pull in the whatever. You could do this or just take the graphs. I'm okay with that. If you just, because all I wanted was a graph. So here in Excel, so you're not going to PDF Excel, you're going to take this graph that we worked on, copy it, and just go to your Word file and just paste it in. There you go. That's it. And a number of people are doing that. And now from here, you an easy PDF. Just go up here and say File, hit the PDF button. That's it. Okay, that's all. So if in Excel you got to select, and we'll do that too. But let's work on this, and then you put the next one underneath. You do the same maneuver again. And if you got to move some of this stuff, so sometimes it doesn't come across very easily, you expand it a bit. See, you can do that in Word. And in the PDF you couldn't really change it. Now just type your answers. You type your answers in there. Type your answers in there. Yeah, the page. Yeah, and this is footnote. You want to put your information in here, your first name, last name, emails, phone number. You don't have to for me, but when you do this professionally, you want to have your contact information. The page numbers are in there. Okay, that's it. And like I said, for PDF, you just hit all you do is hit the PDF button, and it makes a PDF. There you go. See, and that's it. But I think we got it. Yeah, we did the S&P. Yeah, we're good. See? Now you have a PDF of this thing made. There's your PDF. You can email it to Michael Dell and the guy running Facebook, right? You can email it to everybody that you want to. There's a date in there. That's how to do things, folks. Okay, that's how to do things. So you're all set. Okay, so this is the video file. So let's save and shut this thing down. So all of this stuff this is just the data. All that stuff you don't need. None of that you need. Here. Anytime you highlight, you want to hit escape to get rid of your highlight. And also, as we're just sort of sitting here, I just want to quickly pick off. So this we don't need anymore. We can close this thing. I want to pick off some S&P 500 just to describe what we're doing there. Yeah. Let's do like that. Copy. There. That'll be in the description of what we're talking about. We can give ourselves some space here. Board of Exchange. Okay. We're going to put the link in there, and we'll have our second piece to this. Okay, to escape. This has already been uploaded, so you guys already have that. That is mine. You don't have to worry about that. This is regulation, the assignments, the notes. Yeah, we spoke about the notes, and that's it. Okay, and there you go. So you have this thing all set. Folks, thank you so much for spending some time, watching this. I know these aren't short, I know that. Okay, so anyhow, good seeing everybody. and enjoy your Sunday football. Yankees, 3 in a row over Boston, and nowhere to go but up from here. And we'll see you soon.